So Jeff, we see lots of news and headlines about different risks, different markets at the moment. What does this actually mean when you're looking at investments in some of these markets?
So if we go back historically, and we've studied this over the last over 30 years, what we've found is that it's really the cycle that's the big driver. So if we look at past crises, we've had a couple of Gulf Wars, right? Gulf War I, Gulf War II. We've had SARS and many other crises in between. And in every case, the big driver was really whether the cycle was going up or coming down. So when we look at these crises, the question I ask myself when I open the paper every morning is this problem actually going to derail the economic recovery? If the answer is no, then we're still in an uptrend, although the new cycle, of course, plays a role in short-term volatility. Right? I call it short-term volatility. When you're living it day by day, you could get a bit nauseous, but when you stand back in a 5-year time frame, it's really the trend of the economy that matters.
If we think about where revenues come from, there's been this distinction between developed markets and emerging markets. Obviously, if we look at many of the large emerging market companies that you're interested in, many of them are earning lots of revenue from developed markets. So how do you think about that issue, and how does that affect how you analyse and choose whether to invest or not?
Yeah. So there is definitely a mix of revenues within emerging markets. You do have companies which are selling globally, like the Samsungs of the world, for example. If we look at the general trend, the trend has been more intra-Asian trade. So 10 years ago, the bulk of sales of emerging market countries, companies were into the developed markets. Today, it's less than 40%. Right? So the majority of trade is actually among emerging market countries. So if you take a look at the breadth of the emerging market countries, for almost every country in Asia, China is the biggest trading partner. It's no longer the US. If we look more broadly at the entire emerging market world, Mexico is a bit of an outlier. Mexico has very significant exposure to the US in terms of exports. But again, almost every other country, it's more China and other EM being the bigger trading partners. Now that being said, yes, there are still companies around that are like Samsung, TSMC, very important companies that are selling all over the place, including significantly to developed markets. But that to us, it's a positive thing. So there is dispersion and variety in the sources of revenue within the emerging market asset class, and that helps to give diversification and dampen the volatility a bit.
Another element of emerging markets is the currency. So many of the currencies can be volatile. Can you give us some thoughts on how you think about or consider the currencies of the different investments you're considering in your fund?
When we look at currencies, we go right down to the individual company level. So generally we don't hedge country by country, but we'll actually go down to the company level. If you take a country like India, you have exporters in there, for example, IT services, pharmaceuticals, and you have domestic companies like the banks. And even among the exporters, an individual company may have a different proportion of exports to the US, Europe, and the domestic market. So it would be very hard to figure out how to hedge that entire Indian exposure. But what we do is we go down to the company level, we build a profit and loss statement for the company going out 5 years, and we go through and see where they're exporting to, assuming where the currencies are going to be hitting fair value in the 5th year, how that impacts the fair value of the company. So we do that at a company level, and we fold that into our investment decision for the company.